In today's video, we're talking about the upcoming IPO in Portillo's. And if you're from the Chicagoland area, which I'm from, or just the Midwest in general, I don't really have to talk about what Portillo's is, but for everyone else, it's a fast casual restaurant that serves Chicago style hot dogs, burgers, fries, salads. We're gonna be talking about the S1 that came out for this company and talk about the financials and whether or not I think the valuation that it's coming out at is reasonable for its growth prospects. First thing to note is that the IPO date is this Thursday, October 21st. The IPO pricing is supposed to be around $17 to $20, which would give the valuation of the company between 1.2 and 1.4 billion. The company is trying to raise 375 million, and it sounds like they're trying to raise money in order to expand operations. It's also good to know that Portillo's was 100% acquired by Berkshire Partners back in 2014 for around $1 billion. Based on the valuation on the high end of 1.4 billion, it looks like that acquisition in 2014 was a little pricey. As of June 2021, they have 67 operational restaurants across 9 different states. And if we look at revenue, you can see that it was slowly growing, and then 2020 happened. Obviously, the pandemic affected a lot of different restaurant businesses, you name it. The dine-in sales for these companies went down, but what's interesting is if you look at the sales by channel, so drive-through, dine-in, delivery, we'll see that actually a lot of their sales did shift to drive-through, especially in 2020 and then 2021. What's nice about looking at a company like Portillo's is that it's a very simple business model to understand. They're selling food, so in order to grow their revenues in the future, they just need to open more restaurants, establish a bigger footprint domestically. And the goal for the company is to grow at about 10% annually in terms of restaurants. And the long-term goal over the next 25 years would be to establish 600 restaurants domestically and then expand globally in the future. So there is room for this company to grow because with only 67 restaurants, they don't really have that many locations when you look at something like the entire US. If we look at Chipotle as a comparison company, which Portillo's actually brings up in their S1, Chipotle has around 2,788 locations. Now, I will say the difference between these two companies is the operational size of their restaurants. Portillo's has a much bigger operation. Their dine-in experience is much different than something like Chipotle. Chipotle is very streamlined, it's smaller operation. Portillo's, they have bigger restaurants, and each restaurant is uniquely different. So they try to create this experience when you walk into the restaurant, which is a little different than Chipotle, because when you go into Chipotle, you're just there and you're like, yo, give me my burrito bowl, and try to zip through that line. So we have an idea of their growth expectations when it comes to number of new restaurants. But if we look at something like AUV, which stands for average unit volume, or essentially how much each restaurant is bringing in, we can see that their same store sales grew around 2.5% if we look at something like 2020 versus 2021. Another metric that this company seems to be bragging about throughout their S1 is their EBITDA margins. So we're going to take a look at Chipotle versus Portillo's when it comes to profitability as well as revenue growth. That way, once again, we get that nice comparison. But when I look at EBITDA margin, net profit margin, and revenue growth, I can see why Portillo's is bragging about their EBITDA margin because they do have a higher EBITDA margin. But when it comes to everything else, it looks like it's lower. So net profit margin, lower than Chipotle, coming at 5.3 versus 8.7. And then also, if you look at the revenue growth, it's much smaller than something like Chipotle, coming in at 14.3 for Chipotle and only 4.4 when it comes to 2020 versus the trailing 12 months. And the reason I have this weird comparison of 2020 versus trailing 12 months, which includes 2020, is because the S1 doesn't have a 2019 halfway through the year through the first half of 2020. That's kind of what I have as a base, and I'm using the same comparison for Chipotle here. We have to remember that looking at just those figures really doesn't mean anything to us because we have to compare that with the valuation to see if that makes sense versus the growth expectations or the profitability of the company. For the purpose of this next exercise, we're going to assume that the valuation comes in at around 1.3 billion for Portillo's. That way we can come up with something like a price to sales ratio, which comes out to 2.7, or if we look at something like the PE ratio, that comes out to be around 100, which seems pretty high. But when you look at something like Chipotle, that actually has a PE ratio of 90 and a price to sales ratio of 7.44. Chipotle also trades at higher multiples. But the question is whether or not Portillo's deserves those same higher multiples, especially with the growth rate as well as their profitability. Because if we look at something like the PEG ratio for Chipotle, which gives more meaning to their PE ratio, that comes out to be around 2.04. If we try to estimate what the EPS growth for Portillo's is, I'm using a very simple revenue growing at 10% based on their expectations for growth in restaurants, and then having an expectation of 2.5% growth in the sales at the current restaurants. Very simplified, but this is just a way to come up with, hey, based on their net income percentage as well as that revenue growth, how can we see their earnings per share growth over the years and try to back into a PEG ratio. If they have the same net income percent or net profit margin percentage of 5.3% for the next 5 years, you're talking about an EPS growth of 28.4%, which on a PEG ratio, that's around 3.52, so not the greatest. Now, if you factor in them getting better operationally and getting to a point in the next 5 years where they're matching Chipotle, they don't have a growth target for their net profit margin. We'd have to see it over time to see how they're improving, but just a simple assumption here, then you're talking about 43% growth in EPS over the next 5 years, which sounds pretty good. And it does bring the PEG ratio more in line with something like Chipotle. But once again, this is assuming that they're improving operationally as well as hitting those targets of 10% growth for restaurants. Definitely a little bit more of a stretch and not as conservative as the one up here. In conclusion, I'm going to pass on this IPO and Portillo stock. It's definitely going on the watch list. I like the brand and I think they're going to be successful, but it really comes down to that revenue growth expectation being around only 10% and the profit margins in food being so small that I feel like projecting out that higher EPS growth may sound good on paper, but I really need to see it executed. So I need more data points. I need more earnings to come out as a public company. For those of you watching and were thinking about investing, no worries. I will support your decision by going to Portillo's once in a while and getting a hot dog, cheese fries, and a root beer. If you guys did enjoy the video, make sure to hit that like button as well as consider subscribing to Main Street Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching and have a great day.